Thanks everyone for dialing in. My name's Camilla. I work on the marketing team for Ocean Dial Asset Management, and I'm joined by my colleague Gaurav Narain over in Mumbai. Say hi, hello, Gaurav.
Yeah, hi everyone.
Gaurav is our co-head of equities and also the fund advisor to the India Capital Growth Fund. And it's actually midnight in Mumbai. So thank you, Gaurav, for going above and beyond for this presentation. We really appreciate you dialing in. So the overall purpose of our presentation today is to talk to you about a long-term opportunity in small and mid-cap India. At Ocean Dial, we define a mid-cap stock as a company with a market cap between about 700 million and 5 billion sterling. This is the area of the market that our investment trust, the India Capital Growth Fund, predominantly focuses on. And actually, we focus much more on the lower end of that spectrum, with our median market cap being around 900 million pounds. But we really see this as the engine room of India, driving innovation, driving best practice, and really forming a key part of that India growth trajectory. So just before we dive in, I'll just kick off with a bit of an introduction on Ocean Dial. Ocean Dial is an investment boutique focusing on Indian equities. We manage two funds. We have our open-ended UCITS fund, which is more focused on the large cap market. And then, as I mentioned, we have our investment trust, which is listed on the main market of the London Stock Exchange and invests predominantly in India's small and mid-cap market. All of our investment research is based out of our office in Mumbai, and the team follows a bottom-up stock picking approach, investing with a business owner's mindset and in a capacity-conscious manner. So, Gaurav, I mentioned there that we focus on India, and I'm sure that a lot of our listeners will be very keen to hear your take on how things are looking on the ground at the moment. Over the past couple of months, we've seen quite a lot of distressing headlines and reports surrounding the situation with COVID. So perhaps you could just start off by talking a little bit about the numbers there and how things are looking on the ground in Mumbai.
Yeah, sure. So what we've got is we've got this slide on how COVID has played out. And this two big steep inclines on the bar really reflect how the cases have moved in terms of average new daily cases. Now, if you look at the bar on the right, that's where you've seen all the negative news which has come out of India. Fortunately, it's come down once again. But to give you a perspective, when the first wave hit, this is in March of March last year. At that point of time, the government really imposed one of the strictest lockdowns any country has imposed. So virtually 100% of the country was under lockdown, no manufacturing. All of us were, for almost 2.5 months locked in our houses. And the logic then was that the government wasn't sure how COVID would play out, and they really wanted to ramp up infrastructure. So that played out well because the caseloads actually peaked at about 100,000 new cases a day before it declined to almost 10,000 cases a day. At that point of time, everyone felt that the next wave would happen sometime in October, November, and this was really going by the experience of what had happened in the Western economies. But surprisingly, you did not see that second wave. You had the festival season in India, you had marriage season, and really everything was open, but no second wave. And a lot of theories came into play that, there's already herd immunity which has got built in, that Indians are all inoculated for cholera and typhoid when they're born. So that possibly has created some form of immunity. So really complacency had set in. So towards end March this year, when you saw the second wave hit, it was really steep. And as you can see, within a matter of a few days, you went from 100,000 new cases a day to almost 400,000 new cases a day. And really that caught the government absolutely off guard. And I would say two things happened in the second wave. The first is, again, your infrastructure was absolutely caught wanting. Even cities like Delhi, you had situations where hospitals were running out of oxygen. The demand for medical grade oxygen went up 4x for the country. So that was one side of it. The second was that unlike wave one, which was restricted to some of the urban cities, wave two really spread across the country, particularly to rural India. and almost over 50% of the new cases were coming from rural India. So the result was that virtually every family was affected in some way or the other, and there's a big fear factor which is prevalent across the country. Fortunately, as you see now, is that the second wave, the decline has been as steep as the incline upwards. And today, virtually the whole country is opened up once again. So, you're really back to normal. And it really doesn't feel what had happened just a month back, how you were. So I would say that's where we are, that we're back to more of a normalized scenario.
Okay, so many ways that this most recent wave is very different from what we saw last March, not least because of the different stance of the government in terms of the lockdown. Whereas last March we saw this very severe nationwide lockdown. This time around, it's been much more open, and perhaps one of the reasons why we've seen that big increase in cases. But I suppose one of the reasons for doing that is this time around we do have the comfort of the vaccine. And perhaps you could just talk a little bit about how that rollout is going in India at the moment.
Yeah, so if you look at vaccines, India, the positive is that India is, the vaccine manufacturer of the world, and we've been manufacturing vaccines for the World Health Organization. Hence, there's a lot of production capacity here. So if you really look at the chart on the left, the blue line gives the number of doses already administered, and it's already crossed 350 million doses. So after China, India is the country which has actually administered the largest number of doses. But having said that, if you really look at it from a percentage of population, we are right at the bottom. Only about 21% of the population has actually received a single dose. So really, I would say here too, it could have been a lot better. In fact, the government again has come in for a lot of flack simply because they did not anticipate the second wave. In fact, India had actually exported almost 70 million vaccines before they realized that they needed it for India itself, and then they banned all exports. What's happened, however, the positive side is that things have improved dramatically over the last month or so. We were earlier, about a month back, administering about 2.5 to 3 million doses a day. Over the last 3 weeks, this average has gone up to almost 5 million doses a day, and the production capacity is still being ramped up. So the idea, the target is that from next month, you'll be actually doing 8 to 10 million doses a day. And from the government's perspective, based on the data they have from the various manufacturers of the vaccines, they are looking at almost 1.4 billion doses being manufactured between August and December. So really, you're really talking that by December, you'll have 100% of the population vaccinated.
Okay, so as we can see here, the absolute numbers looking very strong, but still a significant way to go on the relative. But from what you've just been saying in terms of ramping up capacity and India's reputation as the world's pharmacy, hopefully we'll start seeing that improve over the coming months. Let's just change track a little bit and move on to the health of India's economy. It obviously took a bit of a battering back in 2020 along with the rest of the world, but can you talk a bit about how that's looking as we move forwards and as we come out of this pandemic?
Yeah, so if you really look at the GDP data, the real growth in GDP, and what you see in 2021, you've seen the sharp decline of almost 9% in real GDP. The figure would actually have been much worse. In fact, when the first lockdown happened, because it was so stringent, you virtually lost an entire quarter of growth in the economy. And so the initial forecasts were that the economy would shrink by 12 to 15%. But as you unlocked, you actually were quite surprised at the pace of revival in the economy. In fact, rural India was doing extremely well. Tier 3, 4 towns were doing very well. It was really the urban centers which really seemed to have got impacted. So we actually saw a lot of earnings upgrades. In fact, when the first wave hit, we'd actually, in our own portfolio, we were looking at an earnings decline of anywhere below 10%. But we've actually ended up the year on double-digit growth. So that that's the sort of recovery we've seen. Now, going forward, I would say the second wave, though it's been very damaging in terms of the impact on people. But on the economy, the impact has been less severe. And the reason is that the government took a very different stand on how they would manage this wave. And they actually left all businesses open, all factories were open, even when it came to lockdowns in the metros, etc. It was actually left to the state governments, which followed a very localized way of seeing where the caseloads were heavy, and they were imposing lockdowns there. So the impact was that the economy continued on its movement. Yes, it did slow down a bit, but it wasn't damaging for the economy. So going forward, you're actually forecasting a very healthy growth over the next few years. And one reason is also that in between this first and second wave, the government has also announced quite an impressive stimulus package, which is really focused on a lot of investments led by the government, more towards infrastructure. It's really not unlike the West, where it's a lot of money being pushed into individual families. In India, the strategy adopted is to really push for investments, and that's giving a lot of positivity. Now, if you really look at even the IMF data, India is, and this chart really reflects it, among the large economies, India would be the fastest growing economy over the next 2 years. For this current year, of course, the 11.5 figure looks very high because there's a base impact also. But going forward, also our view is that you're actually on a 6 to 8% structural growth story, and I'd say there are 2-3 reasons behind that. The first is that even in the 3-4 years to the run-up of COVID, the government itself had done a lot of reforms. You'd virtually revamp the entire taxation system, the entire banking system, the real estate system. So it had the implementation of all these had created a lot of disruptions, and that really already led to the growth coming off. Now all that is actually behind, and the system is actually very clean. To give you a perspective that even with COVID, and you are 1.5 years down on COVID, we've had not one large corporate default in the banking system. So really the cleanup had happened much before. Even on the retail side, you're really not seeing too much impact on the banks, and most banks are very well capitalized. So the banking system is ready to lend. On the corporate side, these last 3-4 years has been seen a lot of deleveraging at the corporate end. So the corporate balance sheet's also very healthy. And what, as I mentioned earlier, now is that it's the government which has really created the stimulus to push for growth. So their stand has also changed from reforms and cleaning up the system to now pushing for growth. So all things I would say are falling in place. Hence, we are very positive that the next 4-5 years will really be the best phase for India, really. So we are very positive on growth being the driver for this economy now.
Okay, yeah, and I mean these numbers sort of speak for themselves, but that coupling of this kind of very growth-oriented government spending, along with these reforms, some of which we know were fairly disruptive when they first came into play, that are now being accepted and embraced by corporate India, really helping push that growth for India. I think it would be good to just talk a little bit about how you're reflecting that and how you're tracking that in the India Capital Growth Fund portfolio.
Yeah. So what we've done is on the portfolio also over the last 3-4 months, we've actually tweaked it around to have a much higher weightage to the economic recovery stories. And we've done it through 3 different ways. The first is we've actually increased the exposure to the banking sector, because really that's the direct play on growth on the economy. The second is, we are anticipating a lot of infrastructure spending. And rather than playing it through pure infrastructure companies or real estate companies, we're actually playing it through the cement companies. So that's another big weight for us in the portfolio. And the third is in the consumer side of the business as well. Here also we've altered the strategy from a lot of staples oriented businesses to more the consumer discretionary businesses, be it direct consumer discretionary companies or say the auto ancillary sort of companies. So I would say over 45% of the portfolio today is geared predominantly to playing the economic recovery in the country.
Okay, so yeah, you've mentioned some key buckets there in financial, cement, consumer, and nearly 50% of the portfolio kind of geared in that direction. Are there any other themes that have emerged, perhaps as a result of the pandemic, that you're tracking in the portfolio at the moment?
Yeah, I think India is also, one big change that's happening and which India is gaining out of is, the trade wars between the US and China. Now, this really started before the pandemic, but what it brought about was that a lot of companies in the Western world were now looking at, finding an alternate or a second source from sourcing purely from China. And with the pandemic, that pace has actually just accelerated. Now, this is really playing a lot into India's hands, and for two reasons. The first is if you look at the chart on the right-hand side, this is really how the wage costs of India compares with China, India, and some other countries. The gray bar shows what the costs were in the year 2005, and the blue bar shows you what the costs are today. So today, India's wage cost is almost 1/3 of that of China. In 2005, we were actually almost similar. So that's one big strength which India has. And the second is really, if you look at the chart on the left, and this is really the government itself has come up with a lot of policy measures to capitalize on this movement. And one of the big regulatory changes they did was on the tax rates. So corporate tax rates for India used to be at 30%. Last year it was slashed to 22%. But more importantly, what they also did was for anyone setting up a new business, a new plant, uh, the tax rates come down to 15%. So that's the lowest amongst the Asian economies which you compete with, from being at the highest end. Along with this, a lot of other incentives has also been provided, where you're getting fixed incentives if you're putting in a specific amount of investments and showing incremental turnover. So that's already started driving a lot of investments into India. And to give an example, take in the consumer electronic space, India imports almost $50 billion worth of electronics from China. And you've already seen, the likes of Samsung, Apple, having set up manufacturing bases in India. For example, Samsung set up its largest plant anywhere in the world in India. And in the case of Apple, all of its three suppliers have set up shop in India. So, all of this has happened over the last year and a half. So you're already seeing that trend of global shift of, China plus one strategy, as they call it, and India being one of the gainers for that. And to give you a perspective, China in almost every aspect is almost 10x the size of India. So even if you're trying to get a small percentage share of that, it's very large for some of the Indian corporates in terms of sort of demand boost you get out of it.
Okay, and if we just turn a little bit to think about the portfolio in that perspective, could you touch on a couple of the companies that are following this shifting in supply chains theme?
Yeah, sure. We've also done we've again added stocks in our portfolio simply to take advantage of these themes. For example, right, and the most prominent one is a company called Dixon Technologies. This is akin to Foxconn in India. It's the largest electronic product manufacturing company in India. So they have the largest market share in TVs. They have the highest share in washing machines and in lighting as well. So they supply to everyone from Samsung, Panasonic, Philips. Even more recently, they've gone into mobile manufacturing and companies like Motorola. They've just shifting 15% of the global demand from China to this company. So that's the sort of trajectory you're seeing for a company like this. And virtually every month they are adding one major global client. So it's a company which is going to grow at almost 50 to 60% over the next few years. Likewise, another sector which is a big gainer is the specialty chemicals and pharmaceutical sector, where we've got four different companies to capitalize on. Aarti is just one, large 5 and 10-year contracts from some of its for global sourcing. Likewise, in textiles, we have the largest home textile company, which is also getting a lot of incremental orders. So I would say, that a whole almost 27 to 30% of our portfolio has already seen these order inflows coming in, which is really a switch out of China into India. I think what's also happening is, even in other sectors, some of the smaller players who are getting big orders from the US and European markets, what is doing it's reducing the competitive environment within India. So there's a lot more pricing power for companies because the demand itself has taken off. And to give you a perspective, in this last quarter, India actually had its highest ever exports. Uh, So that's just showing that the sort of despite the pandemic, you're actually hitting new highs on the export side.
Okay, yeah, so we're already seeing that story playing out amongst some of our companies. And 27% geared to this China Plus One theme, another 45% geared to the economic recovery theme. I'm keen to zoom out even further and look at the overall structure of the portfolio. And I'd also just like to ask if there's something that you're sort of particularly excited about in the portfolio at the moment, if there's anything you can talk to us in a bit more detail about.
Yeah, I think what's also happening is in the last year or so, you're actually seeing a lot of interesting new IPOs also coming out, and finally you're seeing a lot of the digital companies also coming into play. And India has almost 100 unicorns, but the first lot of them have started coming out. So the market is really widening a lot, and that's really very an interesting space. But one of the new companies we've just bought, and this is one of the IPOs, it's a company called Sona BLW. Now, this is actually an auto ancillary company, but it's a very high precision forging company. And it's really a supplier to for certain components like differential assemblies for, say, the electric car manufacturers. Mm. And to give you a perspective, differential is a very critical component which sits between the two rear wheels. That's what rotates the two wheels at different speeds. And this company is actually 100% supplier for differential assemblies to Tesla in China. It's supplying to 50% of Tesla's requirement in the US plant. Now, it's a very rare case where you find that a manufacturing plant in China and the supplier is from a company in India. So that's a sort of strength this company has. And it's not just Tesla. They've tied up with about 10 other EV manufacturers in Europe and US to start supplying these critical components. Now, why I say why it excites is that the quality of this component such that in an EV there is no noise, and a differential sits right under the seat. So that's the sort of precision you require, that even a small bit of speck of sound would be heard. So those are the nature of companies which are really coming out, and so the opportunity set, I would say, is really increasing. And I think the nature of companies we are being able to capitalize on is also increasing. On a portfolio level, I would say today we are fairly well balanced. Almost 87% of our portfolio would be in the mid and small cap space. And when I say mid and small cap space, it's really all the companies would still be leaders in their field, either leaders in the domestic market. Many of them are actually global leaders also. So it's a high quality businesses with great managements that we are playing. The portfolio, as you can see on the chart on the left, it's a fairly diversified portfolio playing both steady compounding businesses as well as the economic recovery. What is interesting about the portfolio today is the earnings growth which we are seeing. And over the next 2 years, in each of the 2 years, we're actually expecting growth rates of anywhere between 27 to 30% per annum. And from that angle, valuation at about 17 times on FY23 earnings, I would say is on a fair valuation basis. The market has run up, but I don't see it being in excessive zones. It's clearly not cheap, but historically, the portfolios have traded at over 20 times as well. So I would say we're still in a zone where you're seeing a lot of opportunities.
Okay, so yeah, you still have comfort there with those valuations if you look at the earnings growth that we're seeing in that table. But that being said, as you mentioned, valuations are running up. We're seeing them moving higher. Do you not think that's something that we should be concerned about?
I come back to my original point where we were talking about the sort of growth slowdown in India due to the sort of reforms we've had. And I have a very interesting chart on what it's done to the corporate profitability. And this chart really shows how the profits for the corporate India is really at all times lows. So unlike the West, where you're at a high, the opportunity for growth is immense because most corporates have really been consolidating, and the disruption because of such strong regulatory measures and all moving totally to a digital economy has had its disruptions. So when you're looking at the growth phase, the extent of growth you really cannot anticipate, because there will be not just top line growth, but the margins, return ratios, everything is really going to expand. And that's why when you look at pure valuations, it's very difficult to capture the nature of the growth that will come in, and the longevity of this growth that will happen.
Okay,
so the
yeah, what you're
real
saying,
kicker, as I see, is earnings growth, which is going to surprise in the positive.
Yeah. So that, as we can see on this chart here, corporate profits GDP is reaching 20-year lows, and as you've just mentioned, there's still plenty of room for earnings surprise on the upside. Thank you, Gaurav. I think we're running short on time, so I would just like to finish on this slide here, which looks at the performance of the India Capital Growth Fund. And if you look at this table at the bottom of the screen, you'll see a snapshot of the fund's performance over different time periods. And you may well be drawn to the 3- and 5-year numbers, which do look a little lackluster if you look at them in comparison to what we're seeing in the index returns. Now, back in 2019, we went through a significant overhaul of the investment team and the investment process. And as a result, we're now starting to see some much stronger performance from the fund in the near term. And actually, on a 1-year basis, we are now outperforming our peer group of Indian-focused investment trusts. But I think the key thing to take away from this screen is what you see here in the blue, which is the average annual return since Gaurav took on the reins back in December 2011. And what this tells us is that if you put your money into the fund back in December 2011, you would have received a 15% return in sterling every single year. Now, that's in spite of a pandemic, that's in spite of this dip in performance. This really demonstrates the power of the small and the mid-cap market. So I suppose the key takeaway for our listeners here is to look at this long-term opportunity that exists in India at the moment. And I think that's something that's going to be much harder to ignore as India becomes a key focus and centre on the global stage in the next few years. So Roland, I'll just leave it there and hand back to you for questions.
We've got time for just a few questions. First up, could you talk through the portfolio turnover rate, please?
Yeah, the portfolio turnover is actually very low. I would say it ranges between 11 to 13%. It was definitely much higher last year during the March, I would say March to June period when the pandemic hit. At that point of time, one did trade a lot more, where you actually de-risked the portfolio considerably. So you really exited at that time. The pandemic really started with the Western world. After China, it was in Europe and US. So you really de-risked by exiting businesses which were very global facing. And some of my auto ancillary companies which were more B2C businesses, where you really didn't know much on what was happening. So I would say that's the only phase where you had a portfolio turnover of about 20% odd. But barring that, historically, it's been very low at about 10 to 13%. And I would say almost 50% of the portfolio I'd have held for maybe about 5 years at least. So it's really, we're buying good quality businesses which we see compounding over a period of time. And any stock one buys in the portfolio, you're looking at holding on to it at least for the next 3 to 5 years. And many of the stocks in our portfolio we've actually exited because they started off as small and mid caps, and over time have become large caps. So almost 3-4 of these companies we've actually exited because they've become $14-15 billion businesses. Even today there are I think 3 stocks in our portfolio which if you see about 13% is large caps, and all those 3 companies are businesses we've held for 3 to 5 years, and they've really grown and scaled up to be large caps, and we've not yet exited them. So really, that's how we look at it. We really take a long-term view. We buy quality businesses and hold it over a period of time.
And that was the next question I had, was about when do you sell, and some of those valuations on the companies on the screen. There was one, I think it was Divi's Laboratories, which was about 11.5 billion. On the, is there a ceiling that you look to sell at then?
Yeah, so I think, Divi's is a company which I've now held for almost 8 years. And it's a company which is really doing well. It's actually a pharmaceutical company, but 50% of its business is what you call customs research and manufacturing. So it's working with almost 8 of the 10 global pharmaceutical companies for their core R&D. So they're really core in the entire R&D, where they are really doing all the work out in India. And it's a company which has margins of almost 40%. And every year they're virtually expanding capacity because the nature of the sort of turnover is growing at that pace. Now, having said that, what we are really doing with Divi's is, because the visibility on growth is so strong, because they are actually adding capacity every time they see the visibility of growth. So we have a very strong line of sight of growth over the next 3 years. But having said that, for me, the key components at what valuation do I sell. So in Divi's case, because I see that long visibility, I'm really playing it by trimming my weights. So every time it goes from a 3% weight to a 4% weight, I take a percent of profit. I really only sell when I see something structurally change in the business. For example, we used to own a motorcycle company called Royal Enfield. It's a British legacy, and they used to make 500cc motorcycles. Now, when we bought that company, they were selling about just about 44,000 motorcycles a year. It was a very niche business, but they created a cult following. And over the next 5 years, this 44,000 a year went to 600,000 a year. But even then, they had an order backlog of about 6 months, and the stock re-rated to almost 30 multiples from mid-teens. But when we saw that order book come down from 6 months to 2 months, that's when we realized that, look, the predictability is going off, and that's when we really exited that business. So it's something has to trigger that change. Otherwise, what I see is India is actually a growth market, and a lot of stocks in our portfolio is what we call our compounders, where you're fairly convinced that the earnings itself will grow at 15 to 18%. And in those stocks, it becomes very difficult to take a call on valuations. Because some of them end up, say, if it's a pure consumer company, these are companies which have return on capital employed of almost 60 to 80%, simply because they have negative working capital, capex is low, and the payouts are very high, and they're growing at 15 to 18%. So in these businesses, you're really playing with your weights, where that structurally the growth is there. You may have periods of no growth because valuations have gone into excessive zone. But then you keep trimming at every point, but still stick with them, because you may not be able to find a similar business at a compelling valuation.
We've had quite a few questions around corporate governance, and could you talk to how you maintain or ensure quality of governance in the portfolio?
So I think that is very key in India, especially if you're playing in the mid and small cap space. So I think one of our key filters is, what we've really done in our investment processes itself, that we've, with a team of 7, of which 5 are analysts, 4 of them very senior analysts. What we've done is we've created what we call our universe. So which comprises today about 140 to 150 stocks. Now, no stock where we even have an iota of doubt on corporate governance really comes into our universe. I mean, there are certain things which you can measure factually on what's happening, and there are certain things which because of you've been in the Indian market for so long, you've heard of things which are not appropriate. So the moment you come across a case where you heard that even there's no factual data on it, that's some things I miss, you say I'm not going to touch it. Because my own experience has been, and I've learned the hard way around, is that there have been times when you've heard that certain dealings are inappropriate, but when you've done your due diligence, and you may have done extensive due diligence, you've not come across anything. And I've had cases where I've spent over a month speaking with 10-15 different people from the industry, But 3 years later, you come across some issues. So my experience has been, if you've heard of something inappropriate, just stay away from it. So I think that's very, very critical in India, especially when you're in the mid and small cap space, that we put a lot of weight on the management quality.
Had quite a few people pick up on the comment you made about 100 Indian unicorns. Question, what sectors are they in? Are they going to come, I guess, when they're public, to the Indian market, or end up floating in NASDAQ or other overseas exchanges?
Well, I think it's a mixed bag, but I think the first breed of them are one of the largest ones is happening in the next 2-3 months. This is the largest food delivery company called Zomato. They've already filed their prospectus in India, and they should be IPOing in the next 2 months. You've already seen, an ad tech come in list. You've seen a gaming company come in list. 2 other big ones lined up is the largest fintech company in India called Paytm, and the largest insurance aggregator called Policy Bazaar. So, you have 3 of these big ones lined up this year. So I think the market will get fairly diversified. A number of them also looking at the US listing for regulatory reasons, that they may not be able to list in India because India has some also very rigid guidelines. So though I think the Indian market's also trying to adapt and change so that most of them come and list here. But the market is also, I think a lot of concern was that the Indian markets will not value these businesses the way they're being valued in the US markets. But you're seeing by the few listings that have happened that they are also getting the sort of valuations, even though some of them may not be making profits here. So the 3-4 listings we've had in the last year and a half, they are getting the sort of value over time, as what we've seen in the Western world. So I would say the market is getting very diversified, and soon you'll have a lot of such opportunities to play in India as well.
Thank you. Final question from me, and it's kind of 2 questions together. The first part is, what are the fees? Talk through that, fund fees. And the second is around the discount management mechanism. If you could talk around those 2 subjects, please.
Camilla, would you want to take that?
Yeah, no problem. So in terms of fees, we charge a 1.25% management fee on the market cap of the fund, which is something that came in following our AGM last year. And then just to turn to the discount management, at the moment the fund's trading on a discount to NAV of about 12%, something that's significantly narrowed from its lows that we saw last year throughout the pandemic. And now that's sort of marginally above a couple of the members in its peer group. Obviously, Ashoka is trading on a premium, but it's broadly in line with JP Morgan, Aberdeen. And actually, we've got a facility coming into play later this year, which is allowing shareholders the opportunity to redeem at a 6% discount to NAV. So that's sort of offering this downside protection in terms of the share price. And we are seeing the discounts sort of naturally amortize, so we head towards that.
Lovely. Well, that's all we have time for. Thank you so much for introducing us to the fund. Thank you for presenting and staying up late.
Oh, thanks, Bryden. Thank you, Gaurav.